adjust my little. There we go. All right. Good afternoon, good evening, good morning, whenever you guys are watching this. The video will be starting up in about 2 minutes here with the review session. And this review session will be over about half of Unit 4 for AP Macro, primarily focusing on the money side of things. So we'll be hitting money, the functions of money, as well as financial assets to cover like what a bond is and things like that. And then monetary policy and the money market. There wasn't a clean break in Unit 4 for me, so I kind of just wanted to have one graph in one video and one graph in the other video. So money market is this video, and then on Thursday, I'll be covering bank balance sheets, money multiplier, and the loanable funds market. So that part of Unit 4 will be Thursday. In my class, we just did Unit 4, like they just tested on it today. So they are probably tired of this content and won't be watching this live. But for future reference, yeah, this will be super helpful to have because Unit 4 is kind of a doozy for people. It seems okay when you're learning it the first time, like hearing what money's functions are doesn't throw you off too bad, or like learning about what monetary policies are, again, doesn't throw people off too bad. It's when questions are asked about it, students tend to freeze up and panic and get confused. Because of wording on test questions and stuff like that, they tend to like overthink it or forget some vocab words. So Unit 4 is usually one of the few tests that I recommend like flashcards for, just because there's a lot of vocab words that if you don't know what they mean, the questions are going to just bully you for. So a lot of the monetary policies and stuff, make sure that you have down and all of that stuff. So yeah, we're going to go through that starting in about a minute here. Yeah. Trying to think of anything else that's important to mention. AP exams coming up. I mean, we're like 4 weeks away as of yesterday from the AP macro exam. And the AP exams start in about 3 weeks. So we are getting there, everybody. Let me pull this up on my end. Cool. Sounds good. All the audio quality is all right. All right. So at 4:30 on mine. Let me take a quick swig of water and we'll get started. All right. So, Unit 4, oh, don't look at that, it's weird. Weird kind of inception thing. Unit 4, some of the big stuff we're going to be talking about today are money, its functions, some of that stuff that counts as assets, the graph of the money market, and monetary policy. Those are the big topics. So, let's start with money. You are familiar with the concept of money. That isn't anything crazy to anybody, but when we're talking about like what is and isn't money, it is kind of imperative that you understand money is anything that can be used to purchase goods and services, which, yeah, makes sense. But what's probably more important is knowing what is not money within our economy. Physical cash on hand, money. Money in your checking account, money. Money in your savings account, not really money because it's not easily spendable. Money that you've used to buy like a stock or a bond. Currently, it ain't money because I can't go to Starbucks with a bond or a stock. So that kind of thing matters. Money has 3 primary functions. It functions as, most importantly, a medium of exchange, meaning you use it to buy things. Wow. Yeah, but like you being able to do that consistently determines how like good of money it is. Talk about things like cryptocurrencies like Bitcoin. One of its big weaknesses is that it's not a frequently accepted medium of exchange. You can't go to Kroger or Tom Thumb or Albertsons or grocery store with Bitcoin and buy your groceries, right? It's getting there, but it's not there with everything. The other 2 functions are that it operates as a store of value and a unit of account. And these 2 get messy for kids in terms of what they are. A store of value means that money holds its value well over time. Oh, look, you can get the arch in the background. That means that $1 today is still $1 10 years from now. It's still $1 10 years ago. Like $1 is $1. It doesn't mean that it's going to buy the exact same things, but it's not like insane, right? There aren't crazy variations in its price. The unit of account is what I'm talking about. So the unit of account is that it was used to judge the value of other goods. So like I was using this example earlier with a student who was reviewing. Your friend tells you that they bought a car for $2,500. Another friend tells you they bought another car for $25,000. Which car do you assume is better? The $25,000 car because it's worth more? Exactly, it's worth more. We use money to determine how valuable things are. So if they cost more, they're presumably a higher quality or rare in some capacity, right? It gets weird with some stuff like collectibles and memorabilia we mentioned in class, like Pokemon cards going for like hundreds of thousands of dollars is kind of insane, but it does tell you what kind of things we see as valuable. So again, those three functions were store of value, unit of account, and medium of exchange. Those are my three functions of money. Now, outside of money, there are other things that you can have that compromise your wealth, and those are your assets. You can have physical assets like a house or a car or a boat or whatever. Technically, anything that you own that you could resell ends up being like a physical asset. So like my computer is a physical asset, my clothes are a physical asset, etc. The big one for this class to know are financial assets, and there are four big ones to be aware of here. Some that are kind of obvious, like a stock is a financial asset. It's part ownership of a company. That's easy. A loan is an asset for the lender, right? You're going to get paid back interest, so that's an asset. Any money that you might deposit anywhere, so a deposit is another financial asset, because your money in your savings account, while it's not technically spendable, is earning you interest and is an asset to you, so that's a financial asset. And then lastly, bonds, which is kind of like a loan. It is effectively a loan agreement. It's just a little more complicated than that. Ends up being our last financial asset. And we got to go through the bond things. That's out of all those assets is the one that you kind of need to understand the best. So a bond is a little baby little like certificate. That'll have some dollar amount on it. That was like the principal cost of the bond. I usually use like $1,000 as my general like baseline for this. And then it'll have what's called the coupon rate, which is like this little interest rate on the bond. I'm just gonna call this 5% on that bond. You buy the bond, you give them $1,000, they give you the certificate, you get paid 5% interest. This could be annually or biannually, it depends on the bond, and it can be for a length of time. Some bonds are 2 years, some are 5 years, some are 10 year, so it varies depending on the bond, but those are the different like maturity rates for it. You buy the bond, they pay you back interest plus the principal amount over time. Ends up being a pretty good investment strategy for you, because you're just giving this business who sold you the bond money right now, so that business has money right now it can use to expand and grow and buy or hire more people and stuff like that. Or if the government's issuing it, they can use that money to help finance whatever plans they're trying to do, expanding the military, funding education, whatever. School districts do them to pay for like new middle schools, stuff like that. All right. Now, the interest rate part of this, which has come up occasionally in my class, is that the price of bonds and interest rates are inversely related. That's a great IR. The price of bonds and interest rates are inversely related. It's a complicated thing to understand, but the basic idea is whenever this bond is initially sold for that $1,000, that 5% coupon rate is locked into play. So when interest rates go down around the country, this bond right here is more valuable because it'll have a higher coupon rate than any new bond being issued. You might see new bonds issued, still $1,000, now with 4% coupon rate. Which bond would you rather have? The 5% one, because it gets you that higher rate of return. So if you were to try to resell it, because when you own a bond, you can resell it, you could sell it for more than what you bought it for, reasonably. That your bond now carries higher value and you can charge a higher price for it because all of the new bonds with their lower interest rate are worse valuable. So interest rates going down brings down all the new bonds' interest rates, so all the old bonds more valuable. So it's an inverse relationship. Gets complicated for kids to understand. If you want to lock in that as like one of your list of many macro relationships to understand, price of bonds and interest rates, inverse relationship. All right. So there's our little like brief snippet of money stuff. Cool. Monetary policy, the fun part of the unit, the vocabiest vocab of all vocab, because it's a bunch of things you've never heard of. All right. Make myself a little bit bigger on this because it's me mostly talking. So, that's a lot of me. That's fine. All right. So monetary policy in a nutshell is actions taken by what's called a central bank, and it's their attempt to regulate the economy. They're trying to help the economy grow. They're trying to keep people having jobs. They're trying to keep prices relatively stable, all the good stuff. It's just the central bank that's doing it. Now, this is different than fiscal, because fiscal is actions taken by the government, and the central bank and government are not technically the same. It gets kind of complicated in terms of like the Federal Reserve for the United States is like linked to our government, but is technically not a part of it, because it's not like in the Constitution anywhere or anything like that. So it gets kind of tricky. I'm like, is this government? Is it not government? It's its own separate thing. Basically, it is the agency that's in charge of regulating banks. It is the bank's bank. When a bank needs a loan, they can go borrow from the Federal Reserve, etc. So the Federal Reserve is America's central bank. So you'll see those words used interchangeably by both me and on the AP exam. If they're being vague about what country it is, they'll probably just say central bank. If they're trying to be nice about it and specify it's the United States, they'll be talking about the Federal Reserve, but those are the same thing. So it's when those guys are trying to regulate the economy, the way they do it. And what monetary policy always comes down to is monetary policy is always about changing the money supply. Now, I made myself too big for this. Why did I do this? Okay. All about changing the money supply. Now it gets kind of tricky because the way they do it is never as simple as just like print more money or print less money. They never give you something like that, which the Federal Reserve kind of oversees but doesn't really control the mint. And the money supply is never just that simple. They have really 3 different tools they can use in this course that you've got to be aware of. There's more in the real world, but these are like the simple ones to understand. Those are changing the reserve requirements, changing the discount rate, and engaging in open market operations. All of these things change the money supply. If it's an expansionary policy, it'll increase the money supply. So expansionary increase. If it's a contractionary policy, it'll decrease the money supply. And that always gets you down to there being more money in the economy allows for more people to spend it. There being less money in the economy allows for less people to spend it. It's kind of that straightforward. So, one at a time, going through these 3 monetary policies so that we understand what's happening. The reserve requirements. In current event news very recently, as of yesterday, the reserve requirement is the percentage of a deposit that banks have to hold on to. By forcing there to be a reserve requirement, the Federal Reserve makes sure that banks actually have to hold on to a part of your deposit. And by making banks hold on to more or less, they can limit what is the money creating ability of banks. We'll talk more about that on Thursday's video with the money multiplier stuff, but the basic idea is through the lending process, banks can effectively create more money within our economy. Because a lot of the money that we have doesn't physically exist. Think of how direct deposit works, think of how much money that's in your bank account you've actually seen and held in your hands. A lot of money in our economy doesn't physically exist, and it's just numbers on a computer screen. So because of that, banks, through some super cool loan processes, will be able to create money that didn't really exist before. So whenever we allow banks to lend more, like for example, by lowering the reserve requirement and not making banks hold on to as much of your money, we are allowing them to lend more and create more money. I mentioned this was in the current event news because as of yesterday, the reserve requirement is 0. The Federal Reserve dropped the reserve requirement all the way down to 0% yesterday as a means of allowing banks to have complete liquidity in terms of banks can loan out every dollar you deposit there right now, which might make you nervous, but 100% and 90% 90% already should have made you nervous, so 100 shouldn't make you any less nervous. The idea here being that banks now have a massive amount of money that they can use to create loans. Because again, pandemic, we need people to spend more. We're still in a recession, technically. Didn't won the whole school year. So, raising the reserve requirement would instead be a contractionary policy, because if you make banks hold on to more of your money, you won't be able to lend out as much. That's the idea. It's almost always come down to expansionary makes it easier for banks to lend, contractionary makes it harder for banks to lend. When I'm saying banks here, I mean commercial banks like Wells Fargo, Chase, your like sort of basic American banks. The discount rate, second one. The discount rate is the price of a loan from the Federal Reserve to commercial banks. So, say Wells Fargo is kind of tight on cash right now and needs some extra money. They might borrow from the Federal Reserve to cover for whatever cost they might have. This is often because banks might loan out too much and not have enough physical currency to back up whenever people want to withdraw. Right? So they might have to borrow from the Federal Reserve or from another bank. If they borrow from the Fed, they pay what's called the discount rate, and that is the interest rate on a loan from the Federal Reserve. So if they borrow $20K and there's a 4% interest rate on that loan from the Fed, that 4% is the discount rate. They can raise it, they can lower it, the Fed can. If they raise the discount rate, make it more expensive for banks to borrow from them, then banks won't be able to borrow as much from the Federal Reserve, so that'd be contractionary. And if the Fed lowers the discount rate, it's going to be really affordable for banks to borrow from the Fed, so they can borrow more from the Fed, and that'd be expansionary. So again, banks can have more money, expansionary, banks can have less money, contractionary. That's kind of how it goes every time. Last one, most important one that is most frequently used on the AP exam and in the real world, the open market operations. Open market operations, or OMOs, are the buying and selling of government bonds. It's when the Federal Reserve engages in either buying off the open market or selling to the open market bonds, aka government securities. Same idea. So, what you got to be able to tell is if they say something like the Federal Reserve buys bonds, you've got to be able to tell is that expansionary or contractionary monetary policy, and that's pretty hard because you kind of have to get what's happening. If the Fed is buying bonds on the open market, that means that they are purchasing them off of the public. They're buying them from commercial banks, they're buying them from everyday consumers, they're buying them from businesses. So they are effectively pushing money into the economy because they are giving cash to the public in exchange for those bonds. Because remember, bonds aren't money. They're useful and they can be a nice way for you to make money in the long term, but they are not money. I cannot spend a bond. So if the Fed's buying a bunch of bonds, then they are effectively replacing bonds in the economy with actual money. So that's expansionary monetary policy. If the Fed is buying bonds, that is big money, makes more money exist in the economy. Some people, I've heard Fed buy bonds, big money, to help you think that's expansionary. Fine. Yeah, more money exists in the economy if the Fed's buying bonds. If the Federal Reserve is selling bonds to the public, that means that banks, people, consumers, they're buying the bonds off of the Fed. So the Fed is selling, I'm buying, I'm giving the Fed money for the bond. Thank you, Federal Reserve, for this bond that I now can't spend, but can hold on to for like 10 years and make money off of. Which means because they're selling the bond and I'm giving up money, there is less money available in the economy now. More bonds, which is cool, but that's not money. So there's less money available in the economy now when the Fed sells bonds. Now, what these open market operations do is they also influence what is called the federal funds rate. And the federal funds rate is the price of a loan from the Federal Reserve, the price of a loan from commercial banks to each other. So say Wells Fargo wants to borrow from Chase, they pay what's called the federal funds rate. And the way that open market operations mess with that is that if banks have more money to lend, it'll be easier for them to lend not just to me, but to each other. So if the Fed's buying bonds and putting more money in banks' pockets, then banks can lend more to each other and offer a lower federal funds rate or a lower interest rate on their loan. So banks having more money makes the federal funds rate go down. Banks having less money makes the federal funds rate go up because they don't have as much money. They would have to charge more for that loan. The naming convention is terrible. The names are very stupid. The discount rate is the price of a loan from the Federal Reserve. The federal funds rate is the price of a loan from banks to other banks. Very dumb naming convention. I am sorry for it. I didn't make it up. I don't control it. Okay. So those three things are our monetary policy. Changing the reserve requirement, changing the discount rate, and engaging in open market operations. Those are my three monetary policies. And again, they change what is called the money supply. And this is specifically the M1 measure of the money supply, which is spendable money in our economy. It is currency in circulation, and it is money deposited into your bank account. It also includes traveler's checks, but no one ever cares about that part. So M1 is what we're talking about when we talk about the money supply in this class for the most part. So when we're talking about money supply and all of this stuff, there is a graph component to it, and the monetary policies are a huge part of it because they change the money supply. the graph we're talking about here, and this is probably the primary graph of Unit 4, is the money market. The loanable funds market, which is the other graph, is actually also important in Unit 5, so that'll come back up in Unit 5. For those of you that are in my class, that'll come up tomorrow when we do notes over Unit 5. So my money market graph looks something like this. It is a vertical supply curve, and this is not a long run aggregate supply curve. This graph is all short run. We've got the supply of money and the demand for money. We have the quantity of money. And we have the nominal interest rate. So, basic concept for this graph is that for consumers, for us, there is actually a price of money that we don't often really think about. And that has to do with interest rates. Namely, there is a cost of us having money. Like you having money in your pocket, you having money in your checking account, you having money that you can spend, there is a cost to it. And that cost is interest, right? Some of you guys have a checking and a savings account, and most students I know have more in their savings than their checking, and that's because a savings account accrues interest. So why would I have it in my checking if I can make money by having it in my savings, which is the right way to think about it. That helps explain this demand curve here. This demand for money is built around the idea that at a very high interest rate, I wouldn't want very much money. And by money here, I mean M1, I mean spendable money. I would rather have my wealth in the form of an asset if my interest rate's really high. Because I'd rather have a bond than physical cash if the interest rate's super high. I would rather have my money in a savings account rather than my checking account if the interest rate on it was really high. Like if my savings account had like 10% interest, I would basically never have any money in my checking account. I would only have enough in there to cover my base expenses. Everything else I am throwing in my savings account and getting rich fast. But at a super low interest rate, I would want to have quite a bit of money because it doesn't make me much to have it somewhere else. Like a lot of my students might realize this because they probably have savings accounts that have a fairly low interest rate. Most people have savings accounts that have very low interest rates, which is why there isn't as much incentive to put it there, right? You might, but it's not as important that you do it when you've got a really low interest rate. Now, the interest rate doesn't affect the money supply at all, because that's all built around how much money is available in the economy. And that doesn't matter what the interest rate is, there will be X amount of dollars in the economy at 5% interest rate, and the same amount if there's 2% interest rate, and the same amount if there's 30% interest rate. We're going to have this whatever amount, whatever this Q at equilibrium is, will exist irregardless of whatever they're charging for interest. Because that money supply is controlled by the Fed. They kind of just control how much money exists or doesn't. So money supply, amount of money available in my economy, it's M1. Demand for money is how badly people want to have spendable money. Again, let's be clear about that. You don't want infinite spendable money because your money can be used for other things. You might want goods. You might want assets, right? There are different things you could want with your money. This is literally how much spendable money do you need to have on you in any given moment. So let's start with the money demand and explain some things that affect it that'll help us understand what's going on here. So some things that affect the money demand, the obvious one is price level, where if everything in my economy is more expensive, we're all going to need more cash on hand, more spendable money to pay for the same goods and services we had before, right? I spend $120 on groceries every 2 weeks, just giving you an example. And if everything got more expensive, I would need to have more spendable cash to cover for my groceries every week, right? So there would be a higher demand for money if price level went up. Income is the second one. The more money you have, the more money you need to buy things. And it doesn't sound accurate. A lot of people are like, wait, rich people don't need money as much. It's like, no. They need money more. They spend more of it. Like, if you're making $500K a year, you're going to be spending more than someone who makes $50K a year. So you're going to need more cash and more money in your checking account to cover for all of that stuff, right? This isn't like a percentage of your wealth. This is how badly you need spendable money. And if you're making more and therefore going to be spending more, you're going to need more. And if you're making less money, you're not going to need as much because you're not buying as much stuff. So don't think of this as like how much money they should get or might need to live. It's more like based on their spending habits, how much money do they need? Rich people need more, poor people need less. To be clear, this is not an ethical argument. It's not what they're asking about here. Last one's technology. So some things like credit cards made the demand for money go down. ATMs made the demand for money go up because people could get cash easier, stuff like that. That's and it's super specific technology for the last shifter. And the money supply, last bit here, this is easy. Money supply is controlled by the Federal Reserve. So whenever they do monetary policy, they are changing the money supply. When they do expansionary, that increased the money supply. Okay, well that would do this. Whenever they did contractionary, that decreased the money supply, that would do this. It doesn't get more complicated than that. So you just got to be able to tell when they're giving you a scenario that involves things like the reserve requirement and the discount rate and the Fed buying and selling bonds, you got to be able to tell, is this expansionary or contractionary? That is the hard part. The graph application is pretty easy. If it's expansionary, more money, higher supply of money. If it's contractionary, less money, a lower supply of money exists. That's about it. I'm trying to think if there's anything else that really matters here. Oh, how this fits into that big picture stuff. So, this is probably the second big relationship right now. In fact, I'm going to type it. Oh my god, it's so small you literally can't see it. Size, huge. That'll work. Separate. Oh my god. Just whatever that is, delete that. Oh god. Oh my god. There we go. Sorry. Keep using this software, not knowing actually how to use it because I'm an idiot. It got bigger somehow. I'm gonna undo this. I'm annoyed. Alright. You are watching somebody figure things out on the fly. Kind of tired. Okay, I'm just gonna write down here. Investment spending. As in the type of spending that is businesses spending on themselves. That usually on capital. It's part of our aggregate demand shifters. And interest rates are inversely related. This is a huge deal for this unit. It is probably one of the most important things in the entire unit is getting this relationship down. Because it'll explain how we go from Unit 4 back to Unit 3 and from Unit 3 back to Unit 4. The idea being that investment spending, which is spending by businesses on capital, but also includes whenever consumers have to take out loans to spend, so things like a home or a car is also a part of investment spending. Because you're like investing in real estate, stuff like that. That spending is very sensitive to interest rates, like very much sensitive to interest rates. Because if interest rates go down, then borrowing gets cheaper. So businesses could borrow and spend more, and I can borrow and spend more. So if interest rates go down, investment spending should go up. Which means, because interest rate was the y-axis on the graph we just had, every time we change that graph, I get a new interest rate. Which means I would have a new amount of investment spending. And investment spending is an aggregate demand shifter. So whenever I change the money market at all, aggregate demand changes as well. As a result of it. If I get a higher interest rate, AD goes down. If I get a lower interest rate, AD goes up because investment spending is inversely related to it. So that's going to be very important for FRQ questions and for just in general understanding that whenever we're talking about like another unit, we can always reference back to the aggregate demand, aggregate supply graph because that was like the graph of our economy. And if any of these things are changing, it's changing our economy. So aggregate demand or aggregate supply, in this case it's aggregate demand, will be changed as a result of it. Okay. That should be it for the Unit 4 review for this chunk of stuff. Let's go into AP Classroom and look at some questions and see how we're doing. How are we doing on time? Great. Less than 30 minutes. Okay. So I'm going to use some of these questions to help review topics as well. So which of the following measures the opportunity cost of holding currency? They mean literal, physical currency, like having actual cash. What have you given up by doing that? The nominal wage rate. I don't give up wages by having cash. The increase in the demand for money. That's not the cost of holding currency. That is what happens when you hold currency. I wouldn't call that the cost. That is just the outcome. The foregone interest on alternative assets being like a bond or a stock or a deposit. Okay, if I have it in cash, I don't have the asset, so I can't collect interest, so I am giving up interest, and that is a cost, so C can work. The ability to access currency to meet unexpected expenses. I mean, I have currency, so I did not give that up. The average income tax rate. I don't avoid income taxes by holding currency. That's not how that works. So it is C. Most of these are the ones that didn't make any sense at all. But C is right, and that is what I was mentioning with that money demand curve, that at a high interest rate, I'm not going to want to have cash very much because I would lose money if I had it as cash. I'd be gaining more by having an asset. 2. Pat deposits a portion of her wages into a personal savings account every week. The saved money can be considered primarily as a what? So it's asking basically which of the functions of money is saving your money actually showing. So means of payment, or which isn't one of them, they probably mean medium of exchange here. Those two, I mean, if it's being used to save, I'm not using it to spend, so that's not what function of money is being served by saving it. Unit of account told me how valuable other goods were, and again, saving doesn't tell me that. Like, you're like saving for a specific thing, it's like, yeah, I just said saving in general. It's just a weekly chunking your money into savings, so it's not telling me the value of any goods. It is telling me the fact that that money is still going to be useful 20 years from now. Otherwise, what's the point of saving it? So that's where store of value comes in. Measure of value isn't a thing. That's just to throw you off. You do have to know some vocab here, which is that store of value, unit of account, and medium of exchange are the 3 primary functions of money. So it had to be B, C, or E. A and D are nothing. They're not anything. And out of those, C is the one that is actively being engaged in this scenario, because money holding its value over time is what savings is all about. The fact that I can save $100 and it still be $100 20 years from now is great, because it means that I've got enough for now. In case things go bad, I'll have enough then, because money still exists. And again, that's why I like something like Bitcoin is risky, because like Bitcoin right now has value, quite a lot of it, but in 20 years, who's to say that Bitcoin isn't completely worthless? So me saving a bunch of Bitcoin is a gamble, whereas me saving a bunch of money has basically no risk. Okay, 3. To reduce inflation, the central bank would most likely to do what? Okay, so we got to figure out what they're talking about. Central bank, monetary policy. Done. If they're saying the words central bank, the central bank does monetary policy is like the only thing you know about it off of this course. That's what they're talking about. It's a monetary policy question. 2nd, to reduce inflation, I gotta think what type of monetary policy would do that, and that would be thinking, contractionary. Expansionary helps you out in a recession. Contractionary slows you down, which would reduce inflation. So I need a contractionary monetary policy. That's what I'm looking for here. So I got decrease the reserve requirement. That's a monetary policy, okay. Decrease income taxes. This is not a monetary policy. It is a fiscal policy. Increase the money supply. That is the outcome of monetary policy that could work, possibly. Buy government securities, sell government securities. Well, based on the fact that these two things are opposites and that they are both monetary policies, probably one of them is the right answer. If it's inflation, that's the problem. I don't want to increase the money supply. I don't want more money available if inflation's the problem. That's just going to cause more inflation. Like, no, they have money now. It's like, no, because they'll spend it more, and know what that means? More inflation. If you have inflation, what you need to do is stop people from spending. Decrease the reserve requirement. Banks can loan out more. That's expansionary. C, expansionary. B is both expansionary and fiscal policy, so it's wrong twice. So we're either at D or E, buying or selling bonds. All right, which of those is contractionary? If the central bank is selling bonds, it's contractionary. Sell bonds, small money. It means less money is existing in the economy. But the idea is that the central bank is selling bonds. It means I'm buying them. I'm like, hey, so here's a bunch of money for the bond. And they're like, cool, so you don't have money to spend right now. And you're like, yeah, but I got a bond. It's like, cool, so you can't spend it? And I'm like, yeah. And they're like, thank God, we need you guys to stop freaking spending because of all this inflation. Right? They're trying to basically take money out of the public's hands, replace it with bonds, which are still good for me long term. But right now, when we've got inflation, I can't go around and buy like 85,000 Kit Kat bars. I'm not saying I would, and cause massive inflation in the Kit Kat market. I'm saying that because I had a Kit Kat bar for lunch. All right, that was another thing I had for lunch. It was one of many things I had for lunch. All right, make myself small so you can see all this stuff. There's a lot of text here. Look at all these things. Oh my God, this isn't even the whole thing. This is answer choice E somewhere down here. Make myself friggin' tiny. Okay. When the central bank conducts open market bond sales. Hey, we just talked about this. What happens to the money supply, interest rate, and aggregate demand? So we can just go off of what I just said. The open market selling of bonds is the Fed is selling bonds to the public. That is contractionary monetary policy. So the money supply decreases. Cool. That is A, B, or C. Cool, I can scroll up and don't have to look at E anymore. This is a monetary policy. And they're talking about interest rates. So what I got to think about is my money market graph. Now, my pen is put away. I will just draw this on my whiteboard, and I'll make my camera bigger in a second. But on my money market graph, if I do a contractionary monetary policy, that means that I will decrease the money supply. So here's my graph. Yeah, you can see that pretty well. It's kind of small, but you can see it. We would get a contractionary monetary policy, which decreases the money supply, shrinks that, gets me an even higher interest rate, like so. There we go. So I'm now up here at this higher interest rate. So I've got A or C will work. I got lower money supply and higher interest rate. And then if my interest rate is higher, what happens to aggregate demand? Remember, aggregate demand is our overall spending levels. They're telling me that there is less money available in my economy. Will we be spending more or less? Less, for sure. Technically, it's tied to the interest rate thing, because if interest rates are higher, borrowing is harder. So like me buying a car or buying a house is a lot harder for me to do. I'm probably going to wait it out and not do it. So A, lower money supply gets me higher interest rates, gets me lower aggregate demand. It does help to know contractionary monetary policies are supposed to do this. Contractionary policies are meant to slow down the economy. The economy is my aggregate demand, aggregate supply graph, and when it's slowing it down, it's decreasing something. It's pumping the brakes. All right, 5. To counteract a recession, the Federal Reserve should do what? Okay, so we're counteracting a recession. We need expansionary policy this time. It's still monetary because it's the Federal Reserve. All right. But I got 2 things for each of these. Oh my God, there's 2. Okay, so I got to figure out, all right, I need 2 expansionary policies here. This isn't a trick. It's not like you should have an expansionary and a contractionary. No. I'm in a recession. I want expansionary the whole way, every time. Raise the reserve requirement and the discount rate. Those are both contractionary. Raising the discount rate makes it harder for banks to lend. Raising the discount rate makes it harder for banks to borrow from the Fed, so it makes it harder for them to lend. A is bad. Selling securities, we just talked about this for the last 2 questions, and again, I mentioned they asked about this one the most. Selling securities is contractionary, so nope to B and C. We are down to D and E, and I just said raising the discount rate is contractionary. It's E. Buying bonds in the open market means the Fed is buying bonds off of me. They are giving me money for my bond. I now have money. Great. I can go and spend it, again, on 80,000 Kit Kat bars. Lowering the discount rate means that banks now can borrow more from the Fed, so banks will borrow more, and now banks have money, so they can lend more to me, so I can buy the Kit Kat factory, like a psychopath. I am on Kit Kats right now. All right. 6. An increase in which of the following will cause an increase in the demand for money. All right. I technically just talked about this also, but that's how this whole thing goes. Increase in interest rates. No, I would not want more money if interest rates were higher. In fact, I would kind of want less. I would rather have my money in an asset. if interest rates were higher. I'd rather have money in my savings account than have it in my pocket. B, the money supply. More money being available to me doesn't mean I want more of it or need more of it. More of it exists doesn't mean I need more. And also, we've never moved like supply as a result of demand or demand as a result of supply. We've never done that, so don't start now. Price level. Higher prices, I would need more money, so that would work. The velocity of money, if you're in my second semester class, we haven't talked about this yet. If you're in my first semester class, you've super forgot about this. The velocity of money is how quickly you spend your money. So if we spend my money faster, I technically can't tell if I would need it more or less, because spending it faster kind of implies I'm doing okay. It's hard to tell. Basically, it'd be like, I don't know, maybe on D. And then the trade deficit, which also, again, second semester kids, you wouldn't have heard this yet. This is a Unit 6 thing. This just means we're importing more than we're exporting. That does not mean we demand more money. Price level is the only one that is clear-cut 100% of the time definitely going to work. Because if things are more expensive, I will straight up need more spendable cash. I will carry more cash in my pocket. I will have a larger amount in my checking account out of my savings. Because everything's more expensive. I'm just going to need more. 7. A contraction in the money supply will most likely change the nominal interest rate and aggregate demand in which of the following ways. Hit on this before, but a contraction in the money supply is a decrease in the money supply. Drew this already, but I'm going to draw it again. For the monetary policy questions, they do kind of repeat themselves a lot because there's not much they can really ask. Either you increase or you decrease the money supply. If it's expansionary, you increase it. If it's contractionary, you decrease it. And there's only 3 monetary policies, so there's not much they can really ask. There's like 6 things they can ask. It ain't that tricky. Supply decreases, cool. My supply went down. Interest rate is higher, which makes sense because if banks have less to lend, they're going to charge more for a loan. And if loans are more expensive, I cannot borrow and spend as much. So I'm going to get a higher nominal interest rate. I'm going to shrink my picture so you can see the answers. I'm going to get a higher nominal interest rate and lower aggregate demand. A. It's kind of the same question as that 3-part graph shift one. But they repeat themselves a lot. All right, 2 FRQs. Here we go. I got 2 of them. Got a short one and got a little bit of a longer one. So, first things first, I read the very first statement every single time. It says, assume an economy with no international sector. What? What does that mean? It means we don't trade. Basically means imports and exports don't have to think about them. It means that this country is isolated. It does not do anything on its own. It's like the Soviet Union back in the day. Does not mean it's like communist. Just means they don't want to trade with anybody else. It's kind of stupid, but whatever. Doesn't change how the graph looks. A, using a correctly labeled money market graph, show how a decrease in the money supply will affect interest rates. If you had this FRQ and you missed this point, I would have fought you. I would have fought you. Because it doesn't ask you to do anything. It just tells you, hey, draw a decrease in the supply. Hey, nerd, draw a decrease in the supply. Okay, so I got to draw this first. My money market graph. Let me get my equilibriums labeled. Start with that. Then it says, show how a decreased money supply affects nominal interest rates. Okay, I mean, if I decrease the supply curve, which is left, some of you guys do struggle with the decrease being left every time, even though it's been left every time, no matter what. Don't know where you're getting that it would ever be right, but it's always left. So it's a leftward shift, and look at my interest rate. Oh my God. It went up. Yeah, that's all you have to do for that. That's 2 points on A. Okay, B, explain how the change in interest rate identified in part A, which is that interest rate went up, will directly affect each of the 3 components of aggregate demand for this closed economy. The closed economy part is because of this. They are closed in that they do not engage with trade with anybody else. And it says 3 components of aggregate demand. That's weird. We usually have 4. What are they talking about? Because my components of aggregate demand, if you will remember, are C, I, G, and XN. Consumer spending, investment spending, government spending, and net exports. Why are they saying there are 3? Oh, they don't do international trade. So imports and exports don't exist. Only 3 then. Consumption, investment, government spending. Now, the nice thing is you can kind of use the same exact explanation for all 3 of them. And this is mostly lazy on the part of the AP exam standpoint because they don't need to ask about all three components. They only need to ask about one because the same explanation applies to all of them. Consumer spending, investment spending, and government spending should all decrease when interest rates go up. Why? Borrowing is more expensive now. It is disincentivizing borrowing. If you're a consumer trying to buy anything, even things that wouldn't normally require a loan, it would make less sense for you to borrow, so you would borrow and spend less, so consumption drops. If you're a business, you for sure won't be borrowing and spending as much because interest rates are higher, and that makes borrowing more expensive, so you won't do it as much. And the government also borrows, that's why we're in so much debt. And if interest rates are higher, you could argue the government wouldn't borrow as much because it is less financially. That doesn't make as much sense financially to borrow if the interest rate is higher. So you could use the exact same explanation for all three. Technically, you could probably do an answer where government spending shouldn't change because the government isn't necessarily beholden to interest rates in the same way, which is not incorrect, but it's one of those times where like there's more than one correct answer for government spending. You could say no change, you could say decrease. Kind of depends on how you explain it. I would just go with decrease and use the exact same explanation for all three because it is the exact same explanation for all three if you say decrease for all three. Consumer spending and investment spending should both drop. Guaranteed. Okay, and then C, using a correctly labeled aggregate demand and aggregate supply graph. It doesn't say long run anywhere in there. Thank you. Don't have to draw it. Also, don't know how to draw the long run here because they didn't tell me, like, is this economy in a recession or not? It didn't give me any hint. So I can't draw LRAS, which, oh no, I can't draw it. I'm not going to complain. So I'm drawing it, I'm drawing it, I'm drawing it. Boom. It says to show how the change in interest rate identified in Part A will affect output and price level. Output is just GDP. Guys, stop getting freaked out by it. They're asking what happened to GDP and price level. Okay, well, I just said in B, 3 different parts of aggregate demand are going to decrease. So aggregate demand should decrease. That is not rocket science. Drop, drop, drop. So how does it affect price level? Price level went down. How does it affect output? Output went down. Okay, well, then I've got lower output and lower price level. It just says to show it. I don't have to explain it, so I would just be using my drawing there. So this question was basically 2 points for drawing the money market graph, and then a second point for drawing the correct shift, which is embarrassing because it just told you to decrease the money supply, so you better not have moved the demand curve. I will straight up fight you if you did that. B, explain how the change in interest rate will affect each of the 3 components of aggregate demand. That part might throw you off, but if you know what your parts of aggregate demand are, and you read, this has no international sector, meaning that they don't engage in trade, which is weird, but isn't like impossible. It's just a weird thing for them to throw at you. It means that they wouldn't use net exports, so it's just consumer, investment, and government. That's it. And then 2 points for this drawing. 1 for labeling everything right on your graph. The second for decreasing aggregate demand and showing that how these 2 get hit. 6-point question. 4 points are based off graphs. You gotta know your graphs. Sorry if that was loud on the mic. All right. Number 9, last one. The Federal Reserve can influence the supply of money. No, thank you very much, AP exam. You guys are so smart. Pat, pat, pat on the head. Good job, Claude. Okay, assume the Federal Reserve targets a lower federal funds rate. Ooh, oh, they asked the federal funds rate, not the discount rate. Oh, that's tricky. Okay. What open market operation can the Federal Reserve use to achieve the lower target? Now, I just mentioned this. I don't talk about this a lot in class because they, frankly, have only asked about this one time. They rarely ever ask about the federal funds rate and how open market operations affect it. But the federal funds rate is the price of a loan from a bank to another bank. How will that price go down? Well, if bank who was lending had more money, they would charge less to bank B, right? So I would need expansionary policy here to get a lower federal funds rate. And if they ask open market operation, I gotta be thinking bonds, because that's the open market operations. It's asking me, what should Federal Reserve do with bonds to get a lower federal funds rate? So what is the expansionary open market operation. That is the Federal Reserve buying bonds, big money. Doesn't tell me to explain it. Thank you, God, for not making me explain it. And same for 2, thank God. Neither of these ask you to explain it because you'd have to write quite a bit to explain it. Short version is, Federal Reserve should buy bonds. That's the answer. Explanation is, because if the Federal Reserve buys bonds, then both banks would end up banks in general would have more money. So the federal funds rate should be lower because banks won't be able to charge as much to each other for loans if they have more money. And then 2, given your answer to part AI, what will happen to the price of government bonds? Okay? This is the price of bonds is inversely related with interest rate thing that I mentioned earlier in the video. And if you need an explanation of that, feel free to go back into the video. But if this is an expansionary monetary policy, I'm getting lower interest rates. So the price of bonds should go up because any previously issued bond would have a comparatively higher interest rate than all the new ones and therefore be worth more. So the price would go up. You can also think of this as, since the government is buying more bonds, the demand for bonds is going up, which would make its price rise. That's an easy way to think about it. Okay, B, correctly labeled graph of the money market. Okay. Show the effect of the open market operation from AI on the nominal interest rate. Can do. Supply of money, demand for money, quantity of money, nominal interest rate. The graph stuff on the AP exam for the FRQs should be easy points for you. If you're a person who has been struggling with the graphs, you need to memorize them. There are only really 6 or 7, so it's not that bad. But you got to memorize how to set them up, because I get a point for doing this. I haven't had to think at all. I just had to remember what I had to label. That's all I had to do. Now, the second point is they did an expansionary monetary policy, right? Okay, well then I'm going to increase the money supply because it's expansionary monetary policy. And again, monetary policy changes the money supply. So I would get a lower interest rate. Boom. Up in my nominal interest rate, it dropped. Okay, C. Assume that the Federal Reserve buys government bonds from commercial banks. Cool, that's what I said in A. Let's say they're actually doing it. Based only on this transaction, okay, will the level of required reserves in the commercial banks increase, decrease, or remain the same? Okay, so let's pause and think about it, because you should pause on this one. The Fed is buying bonds from commercial banks. It's expansionary. Banks will have more money. So the level of required reserves should increase, decrease, or the same. Your probable first instinct is to say increase. That is a trick. Reason being, the required reserves are the percentage of your deposit the bank has to hold on to. When the Fed is buying bonds off of the bank, they're not depositing money in the bank. They're buying a thing from the bank. That's separate. Okay, they're not depositing there. Meaning the banks don't have to hold on to any of that money. Say the Fed bought $8 million worth of bonds from this bank. The bank doesn't have to hold on to any of that because it's not a deposit. So they don't have to worry about any of it. They can use it freely because it's like if they bought a bunch of Wells Fargo merchandise off of Wells Fargo. It's like, does the bank have to hold on to any of that money? No, the bank can use that money however the hell they want. It's their money now. If it's deposited there, then the required reserves change. That's not a deposit. D. Another monetary policy action involves changing the discount rate. Define the discount rate. I saw this and I was like, okay. The discount rate is the price of a loan from the Federal Reserve to commercial banks. That's it. Definition. That rarely happens on AP Macro FRQs. They don't ask you to define things very often. Just because this isn't like a class that's about vocabulary. There just is vocabulary in it. I mean, cool. I'm not going to get mad that they did, but that's not normally a question you'd see. Discount rate, price of a loan from the Fed to banks, or from central bank. Well, yeah, it's sending the Federal Reserve because it's the name for our specific monetary policy. Okay, 522 is on my clock. Those are Unit 4, Part 1 stuff. That, again, was money, the functions of money, as well as money supply a little bit. financial assets like bonds and stocks and how bond interest rates work and all that stuff. Monetary policy, big for the unit, and the money market graph. That was a nice overview of all of those things. I think I hit on just about everything I need to hit on and all that stuff. Again, there are longer videos over each of those topics in my channel. Feel free to look at those if you want more in-depth explanations of a lot of this stuff, especially for the money market graph, as well as for the financial assets stuff, because there's a little more in-depth on how bonds work in my videos there. I go a little bit further in it, so if you're still not sure on how bonds work, because it took me like a good 2 run-throughs teaching this class for me to really get how the bond stuff made sense, yeah, feel free to look into that. That's totally fine. But yeah, that's the first part of Unit 4. The next part of Unit 4 will be on Thursday, and that will include the money multiplier and bank balance sheets, so the math part of this unit, as well as the loanable funds market graph, where I'm going to kind of briefly overview it. I'm not going to go in depth on a couple of parts. There's something called crowding out, which we'll talk about in Unit 5 that involves that graph. But we'll give you like a brief overview of that graph and some shifts there. We're going to focus probably primarily on bank balance sheets and the math stuff on Thursday, but we'll still hit the loanable funds market graph and just make sure that we cover it. I'm not going to go crazy because it, again, shows up again in Unit 5. Okay, that should be it for this video. If you need anything, if you're watching this video after the fact and you have questions, feel free to leave them in the comments. If anything I did in this video didn't make sense, again, feel free to comment with a question. I will straight up respond to it fairly quickly. I can type responses to your comments in the comments, so please, please, please feel free to do so. As always, thank you guys for watching. We've only got about a month until the AP exam, so we're doing Unit 4 this week, Unit 5 next week, Unit 6 the week before AP exams start. And then the first week of your AP exams, which is the week where you guys have your AP government exam, I will be doing on this channel a bunch of like exam prep stuff. So that'll be most like big scale FRQ reviews of like grabbing long FRQs that hit on like things from 3 or 4 units at a time and making sure you see all the connective tissue. And then that's that next Saturday, which is the Saturday before our AP exam. I believe it is Saturday the 8th of May. Yes, it's the 8th of May. I'll be doing a Super Saturday review session, meaning we'll be going live, I think about 9 a.m. is when I said starting that. From 9 a.m. to about 1 p.m., I'll be going through every graph in the course, as much of the big picture stuff as possible. I try to teach the FRQs primarily, and then the multiple choice stuff tends to make sense easier after that. So yeah, we'll be doing all that stuff the next few weeks. We're getting there, guys. We're, again, like 4 weeks away from AP exams starting. Let's finish the year strong. All right. Thank you guys for watching. As always, do greatly appreciate that. I wish you all the best of luck going forward, and thanks, everybody.